This is Mike Swanson of Wall Street Window. I want to talk with you about what's going on in the Federal Reserve. I'm doing this video a couple hours before the Wednesday Fed meeting will be the FOMC statement will be released, and Jerome Powell will have a press conference. But really, everyone already knows what they're going to do. They're going to raise interest rates by 25 basis points, and then he's going to talk afterwards and talk hawkish. Now we'll get to that all in a second. I want to point out to you, look, the stock market has been rallying for the past several weeks. And this is a powerful rally. In fact, it's so powerful that I changed my views on the market. I was bearish on the market in 2022. I was warning of a top in 2021 because the internals of the market turned down while the stock market averages continue to go higher, which has always been a consistent signal warning of an imminent bear market or a 20% or even more correction. And it happened. But now the internals have turned up. And the market has been rallying despite an uncertainty in the economy, and where things are. How bad is the economy going to be? Earnings have been bad. Most companies have disappointed on earnings in the past couple of weeks. You're seeing the announcements of layoffs from technology companies, and yet the stock market has ignored all that. In fact, there have been many stocks that have had bad earnings, gapped down, and then simply rallied and shrugged off the bad news. And people find this confusing. And there is a lot of anxiety among investors because of what happened last year. Hence, you see headlines like this today on Yahoo Finance. Stocks tumble ahead of Fed decision. Well, look, the NASDAQ is down 9 points as I'm speaking. I don't call that tumbling stocks. That's barely a decline at all. The Russell 2000 isn't even down a point. People are making so much out of every little gyration in the market. And after the Fed meeting today, don't be shocked if stocks make swings up and down. And then 2 or 3 days later, what happens will almost, it just won't mean nothing. Fed meetings typically bring strange, volatile swings in the market that tend to mean nothing a few days later. And I think that is going to be the case now. But just to give you an idea of, what the way things are right now, consider this headline. Michael Burry says sell and Jim Cramer says buy. As the Fed meets, here's how both could be wrong on stocks. Well, what does that mean? How can they both be wrong if one is saying sell, one is saying buy? It's nonsensical. But the very fact that one says sell and one says buy is also creating more uncertainty among people reading this stuff. And look, how do you navigate this situation? First of all, let's talk about the Fed meeting. Okay. Look, like I said, everyone knows what they're going to do. They're going to raise rates by a quarter point, and they're going to set the stage to raise rates by another quarter point in March. But the thing is, that is almost certain to be the end of this Fed rate hiking cycle. And you saw last year when interest rates were going up by 3/4 of a point, it smashed stocks, it smashed gold, it beat things down because that's what the Fed rate hikes were designed to do, because that was necessary to stop the inflation from continuing to explode. Well, the rate of inflation has stopped going up. It started to soften and come down. That's what the Federal Reserve wants to see. But the Federal Reserve is in a dilemma. It doesn't want to raise rates too much because then it would sink the economy in recession, be forced to cut rates quicker than it wants to do, because that would cause inflation to explode again and get us just right back to where we were at the beginning of last year. However, if the Fed raises rates or lowers rates too quickly, then inflation will explode too. So the Fed is caught in a bind. It doesn't really want to do much of anything at the end of this Fed rate hiking cycle. It's going to want to keep rates, at the end, at a steady spot for as long as it can for the rest of this year. Most stock market investors aren't understanding that. They want the Fed to lower rates as quick as possible. They think that will return the market back to the way things were before 2022. And yet, it's not necessary. The stock market is already rallying. It's not necessary to lower rates to get the market to rally. It's already doing it. And the internals of the market have improved because in the end, interest rates of 5% is still dovish when inflation is above that rate. And even if inflation fell to 4%, it would still be an easy policy as far as the financial markets go. And that's why things are rallying and are likely to continue to rally until things really, really change. And things are actually happening in slow motion inside the economy and the way this financial markets are moving. So I don't think there's going to be some dramatic change from the way things stand now for the rest of this year. Probably not for quite some time. This is like moving like a glacier. That doesn't feel apparent to people when all they focus on is minute by minute gyrations and what is going on, every second. And the headlines reflect that, using words like tumble to describe a very short-term gyration of the stock market, where the NASDAQ isn't even down 0.1%. Now the Russell 2000 is green. These are very tiny gyrations that don't mean anything, but when you load it up, you want to see, and they deliver to you, headlines and stories to explain it when it doesn't mean much of anything. So what does matter? Let me show you. We can get access to my charts here. So I can show you some stuff. What really does matter in these markets. This is a chart of the S&P 500. And the thing is, it's trading above its 200-day moving average now. It's trading right on its December, November highs. This has been internally, and that's as far as the number of stocks participating in the rally, the strongest rally in the markets in well over a year, because the internals of the market peaked out at the beginning of 2021. So this is a broad-based rally inside the stock market. But the reality is other markets around the world are going up better than the U.S. stock market. You can see that from the emerging markets ETF. It rallied through the December, November highs already. The price of gold has taken off in recent weeks too, as you can see here. So, what's happening is when the Fed went on its pace of raising rates by 3/4 of a point last year, it helped spur one of the things that happened. It spurred a strong rally in the US dollar indexes, which you can see here. That made gold, silver, markets around the world, such as Europe, such as China, such as emerging markets, ETF, fall really bad. But then the dollar peaked out as the Fed took its foot off the pedal from 3/4 rate hikes to 50-point hikes, and now it's set for 25 rate point hikes. That caused the dollar to go down because currencies are impacted by monetary policy. The comparison of how dovish or hawkish our Fed is compared to other central banks has a powerful impact on the dollar, which impacts our experience as American investors and the returns we get from investing in things such as gold, silver, in world markets, because they're all impacted by the value of the US dollar. So right now, while the S&P is in a nice rally, there's more money to be made by investing in markets outside the United States, because the dollar is falling in value, which helps push them up in relative terms for us. So I own, for example, this ETF, EWG. It's going up much more than the S&P 500. It's done so since October. Look at how powerful the rally is. Already smashed through the December, November high. What we're essentially seeing now is a global rally. I think a global cyclical bull market, one that will last likely 2 years, but this is not a simple bear market rally in a couple stocks. This is a global market rally. It began in Europe, it began in your emerging markets, and it's now that the S&P and the NASDAQ are following suit. But even inside the S&P and 500 and in the U.S. stock market, there are sectors vastly outperforming those averages, that doing better than the past fad plays of yesteryear, such as Google, such as Apple, such as Microsoft. You can go on and on and on. They're just exploding higher. Bank stocks are one of the leading sectors in the market now. The XLF ETF is doing well. It's because the rise in interest rates is helping banks make more money. Because they charge interest. They're able to make money. When interest rates were zero, they were really suffering. Now they're doing much better. This is the situation we're in 2023. And it's not going to end next week. This is going to go on for the rest of the year. Don't look. So what's going to happen today? The Fed, when they come out with their decision, and I'm doing this before the decision's even made, the most important thing that the Fed is going to try to do, and it's going to succeed, is going to express control of the situation. They are going to do their 25 rate hike, and the entire goal of that statement and Jerome Powell's press conference afterwards is going to be to express that they have control of the situation. Now, it's not really the case that they're going to be able to keep that control forever, because the day will come in which there will be a crossroads in which inflation will come back. That's not today. That's not next week. It's not next month. It's probably not. It may not be for 2 more years, but that day will come. But it's not here now. Inflation is the rate of the inflation is coming down from the pace of it. And that's good. And they're going to talk about that. And they're going to talk about how they're going to keep rates tight, and they're going to work to improve this more and more and more. And the market's going up because they're not raising rates at 3/4 of a point, and they're not, they're just going to do it one more time. That's what the stock market is focused on. That's what stock market traders are focused on, that are buying. And there's more people buying than selling. And that's where we are now this year. Things will change one day in the future, but that's far away. And this is a slow motion cycle that we're now in, and it means it's positive time for stocks. Wasn't a positive time last year, but it is now. And gold and silver are even better positions. So today, look for Jerome Powell to demonstrate that they're in control of the situation. Look for CNBC and the financial outlets to echo that. And the Dow may fall. I don't know what it's going to do after 2 o'clock. Maybe it'll rally. Maybe it'll fall. Flip a coin. It's very difficult to day trade these markets. Focus on intermediate term trends. And we're above the 200-day moving average. That's what's important. It's very difficult to figure out everything that's going to go on. This isn't about predicting the future. No one can predict exactly how the economy is going to do this year. How many people are telling you are headed for disaster in Europe this year because of a cold winter, because of the Ukraine war? It's going to make energy prices explode and throw Europe into a depression. Well, it never happened. In fact, we've just seen this week GDP numbers released that show the European economy has actually grown instead of shrank in the last quarter. The IMF had to upgrade its economic forecast for global growth too. That was yesterday. Things are nowhere as bad as people were thinking they were going to become 6 months ago. That's one reason the stock market is rallying, because we're in a global bull market, and the U.S. market is simply following the rest of the world up. It's not always been like that in the past. In fact, from 2009 till really the past 6 months, the U.S. stock market outperformed as a whole markets around the world. Last year, the U.S. dollar went up. because the Fed was raising rates at a faster, sharper pace than other central banks were doing. And once they reached the peak of that, quickening cycle, things changed. And now we're in that market environment, much different from last year, but much more positive overall for those that want to be bullish on stocks instead of bearish. The time to be bearish was last year, not now. And that's where we're at. Don't worry, the market fluctuates, down because Jerome Powell might speak a little hawkish, but he can't do hawkish things after next month. And that's all that's going to matter going forward for the rest of this year. So those are my thoughts today. It's going to be a drama theater, I guess, this afternoon. And look, if you like this video, hit like. You want my next video, you're new to my stuff on YouTube, hit subscribe, hit bell next to it, and then YouTube will send you an alert as soon as that next video is up. And I'll be talking with you